While retail investors focused on quarterly revenue growth, institutional capital quietly triggered a massive risk-off liquidation across the semiconductor landscape. The absolute dominance of advanced computing tech is facing its first real structural test as large-scale portfolio managers re-evaluate their over-concentration risk. For over 18 months, a handful of megacap names have single-handedly carried the major indices. But as we saw this week, when supply chain bottlenecks meet valuation limits, the downside volatility can be incredibly swift. This shift represents a fundamental repricing of future growth assumptions, forcing a broad market rotation that is catching many off guard. To understand where the capital is flowing, we have to look closely at the core moats of the semiconductor ecosystem. Hardware designers like NVIDIA and AMD, alongside toolmaker ASML, command unmatched pricing power because they control the physical building blocks of advanced computing. However, their highly specialized business models are deeply vulnerable to supply chain disruptions and geopolitical friction. ASML's lithography systems are single-source bottlenecks, meaning any delay in global infrastructure development immediately impacts the production schedules of every major foundry. This dependency creates a massive point of systemic failure that the market is finally forced to price in. But that is only part of the story. While technology sector moats feel the squeeze, defensive structures are gaining structural momentum. Large money center banks, led by J.P. Chase, possess massive low-cost deposit bases and structural credit systems that behave as critical economic stabilizers. Simultaneously, global energy players like ExxonMobil control tangible, cash-generating assets with pricing power anchored to commodity demand. When systemic risk rises, capital naturally leaves speculative, high-beta tech companies and seeks shelter in these highly insulated, cash-rich business models. This classic defensive pivot is beginning to alter the performance profiles of major indices. Here's where the margin metrics become interesting. Across the semiconductor value chain, capital expenditure requirements are expanding faster than realized revenues. High-end chip design costs have skyrocketed, and foundry pricing from manufacturing partners remains steep. This puts severe pressure on operating margins, meaning even minor misses in shipments can lead to sudden margin contraction. When NVIDIA or AMD report anything less than pristine execution, their elevated multiples face immediate downward pressure. Institutional analysts are looking past top-line growth to focus on the unsustainable capital intensity of maintaining this rapid pace of expansion. Now look at how the broader sector is reacting. J.P. Chase reported strong early earnings, yet the stock saw selling pressure due to cautious net interest income projections. Financial institutions are realizing that high interest rates are a double-edged sword. While loan yields are high, the cost of retaining deposits is climbing steadily, eating into net interest margins. This margin compression in the banking sector is a leading indicator of tightening credit conditions across the entire economy. It shows that even the most well-capitalized institutions are planning for a more difficult operating environment ahead. The next signal comes from management's capital allocation and delivery timelines. Senior leaders at ASML and other critical chip equipment suppliers have begun highlighting structural bottlenecks in global foundry build-outs. It is not just about designing the next generation of chips, it is about the physical ability to build out cleanrooms, secure electricity grid connections, and acquire lithography machines. Management teams are signaling that the hypergrowth phase is shifting toward a slower, more complex integration phase. This conservative forward guidance is forcing institutions to rewrite their long-term growth models for the technology sector. In stark contrast, management commentary from traditional energy heavyweights like ExxonMobil centers entirely on capital discipline, cash generation, and robust shareholder returns. Rather than investing in speculative capacity expansions, they are choosing to return excess cash flow to investors via share buybacks and dividends. This highly disciplined approach to capital allocation appeals greatly to defensive portfolio managers who want tangible yield over long-dated growth promises. In an environment defined by high capital costs and global uncertainty, these strong cash flow profiles are becoming extremely attractive. That leads us to a bigger question regarding terminal risk across the broader industry. The macroeconomic environment is undergoing a permanent structural shift. Higher for longer interest rates and sticky core inflation are changing the math for equity valuations. When risk-free yields remain elevated, the net present value of far future cash flows drops significantly. This directly impacts high-growth tech companies whose high valuations are based on earnings projected years down the road. Meanwhile, short-duration assets, which generate substantial cash flows today, see their relative value rise in this challenging market landscape. Beyond inflation, the geopolitical landscape is driving a classic commodity tailwind. Increasing tensions in the Middle East have pushed global crude oil prices higher, directly benefiting major producers like ExxonMobil. Historically, rising energy costs act as a tax on the global economy, reducing consumer spending power and increasing input costs for manufacturing. For technology companies, this represents a double whammy of rising costs and potentially weakening end-market demand. Institutional money is recognizing this correlation and positioning defensively in commodities to hedge against worsening macroeconomic trends. Something important is happening here, and it centers on liquidity. The extreme concentration in high-beta tech stocks has created systemic vulnerability. Many quantitative funds, trend followers, and leveraged retail traders have built massive, overlapping positions in names like NVIDIA and AMD. When a sell-off is triggered, it often forces automatic liquidation programs to kick in, creating a cascading downward spiral regardless of fundamental value. This systematic deleveraging is exactly what we are observing as the Nasdaq and S&P 500 lose key technical support levels, turning a routine correction into a broader market risk-off event. But the risks extend beyond automated liquidations. The ultimate threat is structural multiple compression. If hyperscale cloud providers scale back their capital expenditures on high-end chip designs, the growth rates for hardware developers will slow down dramatically. A company trading at 40 or 50 times forward earnings cannot afford a slowdown without experiencing a violent correction. If the market begins pricing these cyclical semiconductor leaders like traditional industrials, the valuation adjustments will be severe. This is the core risk keeping portfolio managers awake at night. So, what changes next? We are entering a phase of significant capital rotation. Wealth managers and pension funds are actively reallocating capital away from overvalued technology shares and shifting toward real-world assets. High-quality financials and energy giants offer far better valuation insulation in this uncertain macroeconomic climate. This rotation is not a short-term blip, it is a long-term adjustment to high capital costs and supply constraints. As a result, we expect defensive, value-oriented sectors to show relative strength even if the broader equity indices continue to experience downside pressure. The market appears to be pricing in a split economy. On one hand, physical energy and financial liquidity remain highly profitable and stable. On the other hand, the high-flying tech sector must work through supply-side challenges and valuation resets. This means investors need to adopt a new valuation playbook. High-conviction focus must be placed on balance sheet resilience, positive free cash flow yields, and structural moats that can withstand persistent inflation. The era of buying any tech stock simply because it mentions AI is officially behind us. Taking all this into account, let's look at the tactical setups. For semiconductor giants like NVIDIA and ASML, we are maintaining a strict trim consideration. Their current valuations are vulnerable to slowing growth, making it wise to lock in profits and reduce exposure. Conversely, we are keeping a close breakout watch on cash-rich value plays in banking and energy, such as JP Chase and ExxonMobil. These companies are well positioned to benefit from capital rotation and defensive positioning, offering strong downside protection while generating consistent yield. To navigate these shifting markets successfully, you must look beyond the daily headlines and focus on structural trends. If you want to protect your portfolio and stay ahead of the curve, make sure to subscribe to SR Money News. We bring you institutional-grade equity research and deep macro analysis to help you make informed decisions. Hit the subscribe button, turn on notifications, and share your thoughts in the comments below. Let us know how you are positioning your portfolio for this major market rotation.